And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story, real talk about money, markets, life. Now, it's The Real Investment Show, presented by RIA Advisors.
Good morning. Welcome to The Real Investment Show. I am Danny Ratliff here with John Penn for your Financial Fitness Friday edition. Hope everybody's off to a great week. End of the week.
End of the week. Friday is here. Somehow.
Somehow. It still
fast.
feels like Monday. So markets bucked the trend this week. We did have 3 up days to start the week. Yesterday, obviously, one of the worst days that we had seen to start, and we did gain a lot of that back. Been an interesting week. Over the night, we saw trading boosted by Alphabet and Microsoft. Obviously good earnings there. Kind of interesting as Meta took it on the chin, spending a lot more on AI than expected. 10-year treasury yield at about 4.74. A lot of this on the heels of lower GDP. So GDP expectations were, GDP came in a lot lower than expected. Personal consumption expenditures were up a bit. We do get the PCE numbers out today, this morning. I know the Fed, that's the main tool they typically look at for inflation. And, the word on the street is stagflation, John. And I think that that's the biggest concern is what actually happens here. Talked to Lance a bit last night about just the overall big picture, what this looks like. And, he doesn't seem to be nearly as worried about stagflation. But if you look up any of the main headlines from yesterday, where we see a slowing economy, higher unemployment, which we're not there yet. Unemployment's still been very resilient for the most part, unless you look under the hood, and then higher inflation. So Lance seems to believe that we're going to see, as over time, a lot of these, number one, are estimates. They're polling a bunch of people in a room and saying, hey, what do you believe this is going to be? So always subject to be revised. So keep that in consideration. And also, a lot of times these things follow each other. So sometimes you get those leading economic indicators, what we like to call them. But, if we look at retail sales over time, that has been stronger. We did see actually numbers revised for earlier in the year. But, as Lance will point out, if we look back just in March, which did have 2 major holidays, that wasn't nearly as good as what was anticipated. So obviously waiting to see what happens here this month in April. Darn near towards the end of it now already. So you're talking about Friday was here, John. I mean, I can't believe we're here April 26th.
Crazy.
It is crazy. And, so lots of news going out. I mean, who would have thought that we would have seen so much happen so quick this year? I mean, just this month, Meta beats earnings expectations. Stock was down 10% based on the amount of money they're going to have to spend on AI. Operating margins were changed a bit too. Tesla misses expectations, up 10%.
It's a promise of those lower price vehicles, right? For the consumer for Tesla, and maybe Elon gets those out a little bit sooner than anticipated. So a little bit of hope in that message, I think, for folks on the Tesla side.
I think so. I think that's exactly what it is, especially with EVs been taking it on the chin in general. I mean, you see a lot of these major car manufacturers, cutting production, cutting their R&D on that for the moment. And that's going to be interesting to see how that plays out over time. And that's, I think the election may have a little bit to do with that as well. But markets price out essentially 4 rate cuts so far. Gold hits all-time highs. Geopolitical tensions worsen. Bitcoin, which has been all over the place, is up or down, crashes. And then mortgages have been interesting to follow because housing prices are pushing higher. Yet mortgage rates have risen. And this is going to be something I think that's going to really put a damper on things over time if people are still unable to move. We've been expecting, and I think a lot of people have been holding off on a lot of things in the sense of, should they continue to rent? Should they move? Or if you're in a home, you can't afford to go buy something cheaper. And so there's been this pent-up demand, I believe, where you're going to see a flood of inventory at some point. But it looks like that's pushed out longer. Everybody continues to wait for these lower interest rates. And a lot of people think that, hey, lower interest rates are going to make prices increase. But I don't know if that's going to be the case if everybody comes out and puts their home on the market at the same time. I think people are trapped.
Oh, there are a number of folks that I'm visiting with that they would like to sell their house, maybe move to a kind of more of a retirement destination. Maybe they're wanting to get out of the Houston heat for a little while, but they're like, well, I'm not going to sell my house right now, John, because if they do have a mortgage on it, their rate is 2.5, 2.6, sub 3%. They don't want to give that up.
That's right.
They are in no hurry to give that up right now. At least that's the message that I'm hearing.
Well, and if you do give that up, you're going to give it up for, number one, a higher rate. But number two, even if your intent was to downsize, your payment may not be lower. Which is crazy.
Yeah. Well, that too, and they're looking at, so just yesterday I was visiting with a couple who said, I think we're going to keep our house a little while longer. And, because they would like to move to get closer to family. But now they're also looking at, the property taxes that we pay here look pretty good compared to where maybe we'll be moving, right? So there's a lot of that too. I think just folks kind of watching their bottom line, watching their budget. But yeah, a lot of folks right now, they don't want to sell because then they have to go spend something of equal value, or their payment it just wouldn't be a better situation for them, at least initially.
Yeah, and I think we've already seen that a lot. We've seen in the high tax states, people moving to lower income tax or no state income tax states. I do believe, we do a lot of these analysis and studies for people in the sense of, hey, I'd like to get closer to kids. We're thinking about moving from here to, to here. And you start breaking it down. All these states have one way or another to get their hands on your money. And, it may be car registration in some states where here in Texas, for instance, what is it, $85? It may be $500 or $600 somewhere else. Property taxes may be much less somewhere, but they get you at the state income tax or something, so there's lots of ways for them to do this. So keep in mind, and I would go through, and if you're looking to move, which we're hearing from a lot of folks who are, make sure you understand the ramifications. And, we got to think about how far does our money go.
Exactly.
And that is where, a good financial planner, we talked about this the other day. We're going to finish up some kind of topics from last Tuesday when you and I were together. Just some tips if you're going into retirement or you're already retired, things that you should be considering. And then taxes. President Biden came out and basically promised Americans that we would see higher taxes should he be reelected. Now, claims this is only on the wealthy. I don't know if that's the case. And we're going to talk a little bit about why and what actually happens from here and how taxation works, but not only just that. We talked last week as well, Rich and I did, about just who pays the burden of taxes in general. Like, how much, what are the percentages, what are the tax rates, and kind of getting a good understanding. So Tax Cuts and Jobs Act expires this next year, end of 2025. And so what does that mean for the individual? What are tips you could be doing right now to keep more money in your pocket? And so I think that's going to be crucial. So we can kind of go through this year. I believe, at the beginning of this year, economists believe there was no way that they were going to see a recession. In fact, Lance has a great article out today. Retail sales data suggests a strong consumer, or does it? But he quotes in here that it's saying, it has been 2 years since forecasters felt this good about the economic outlook. In the latest quarterly survey by the Wall Street Journal, business and academic economists lowered the chances of a recession within the next year to 29% from 39%. This was in a January survey. That was the lowest probability since April 2022, when the chances of a recession were set at 28%. So they don't even think it'll get close to a recession. Now, is that changing? We'll talk a little bit about that on the other end of this. Thanks for joining. You're listening to The Real Investment Show. We'll be right back.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
So you're ready to retire, but are you ready to transition to Medicare? Knowing how health insurance works after you leave your job is vital. Our next Lunch and Learn will tackle transitioning to Medicare, Wednesday, May 15th, with Danny Ratliff and Richard Rosso. How do you sign up for Medicare? And how will it work with the insurance you already have? Food for thought and food for your belly. Register now for our Transitioning to Medicare Lunch and Learn with Ratliff and Rosso at realinvestmentadvice.com. realinvestmentadvice.com.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
The Real Investment Show.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
Welcome back to the Real Investment Show. I am Danny Ratliff here with Jonathan Penn. So we've been covering things that you need to do or be considering as you're getting towards retirement and ways not to screw up retirement. And I feel like we've been doing this for a while. It's just kind of going in perpetuity where, you guys have been great wealth of information in the sense of, hey, have you thought about this? Here's something that we do. And we see this in practice quite a bit as we're helping folks retire. Maybe they've been there for quite some time or, getting into that stage. And so as we progress, last couple of days ago, we talked about, what are some of the things that you need to be thinking about? How do you get there? It's problematic in a lot of ways. Retirement is expected. Everything we do, we practice. My child, they start a new sport. They practice. To get into your job role, there's typically steps that you take, training. You go from one job to the next. As things progress, you gain more knowledge. And retirement in a lot of ways is fairly similar, but most people don't get the luxury of practice. It's actually, practicing as you go in a real life scenario. So, I think some of the things we've talked about, John, are easy. We talked about some of this is just low-hanging fruit, stuff that most people know, but it is difficult to put into practice.
Well, it is because for so long you're in this accumulation mode. You're kind of running on the treadmill, right? You're save. Yeah, and you're, maybe you're traveling a little bit, having some fun along the way, but you're so focused on getting up and over the peak of the mountain, right? Now you're over the peak of the mountain and now you're on the other side and you switch from that accumulation phase now to where you're the distribution phase. And I can't tell you the number of folks that I visit with that after they get into retirement, a couple months in, they're like, wait, this just feels strange. It's just kind of wrestling with the emotions of it where it's like, hey, I'm so used and accustomed to having this steady stream of income from my previous job or my employer or my business. I'm so used and comfortable to having those streams of cash flow coming in. So I know, Danny, if I need to do some fence work or have some work done to the house, I'm all right because I know here in a couple of weeks I'm going to get paid again. I got some cash flow coming in. And now it's like, well, hold on a second. I may not have these cash flows coming in. Maybe I'm going to hold off on it. It's just a different mindset. It's very emotional for a lot of folks. And sometimes you just kind of get thrown into it and sometimes you're not ready for that, right?
No, I
can't practice it because you just kind of get thrown to the fire to a little bit.
Yeah, I mean, there's ways that we've helped people practice it. Mm-hmm. It's still difficult where maybe you put all of your paycheck into one account that you don't technically, it's not your checking account. And then you make distributions from that account on what you'll need to live on, even though that number may look a little bit different in actual retirement.
Sure.
But just beginning to, I think conceptually, when we see it, it's easier for us to understand, and we've been there, we've done that, where if we can go through a kind of a trial period for so long, that's certainly helpful. But there's nothing like actually sitting at home without that paycheck coming in. That human capital is not the same, right? But now we have to figure out, what do we do with our life? What's our sense of purpose? Where do we go, and where do we get the fulfillment from? And it's something that, if you're married, you need to talk to your spouse about things that you do together. But, we've been talking about this, as I alluded to earlier, for quite a while. And if you missed that, go to YouTube, go to The Real Investment Show, hit subscribe. You can go back and see there's lots of tips on this. But, some of the things we talked about is, people not bothering to save, or not even, thinking about doing a financial plan. I mean, we hear about it often where somebody, they delay, they push back, they say, I'm not going to do the plan until we actually, we go to retire. Well, that's a big mistake, because there's so many things we can do ahead of time to make sure you're not leaving anything on the table, from a employment benefit, a saving benefit, diversifying your assets in many other areas. We talked a little bit about that. I'd like to talk more about that too. I think people they underestimate their needs, or they don't quite understand what they're living on now. So, we talked about the 4-letter word of a budget. And I had somebody actually this week, they brought in their pay stub, and they brought in all the ways they save. In addition to that, like, okay, here's my taxes, here's my insurance, here's my 401k, my stock plan. Here's also where I'm putting money in a savings account. Here's where and so we actually went through the numbers, and while he thought he was making X, he was actually receiving much less. So he's like, man, I thought I needed a whole lot more to live on. I clearly don't. But then we start going in and say, well, let's look at your regular expenses. And then on top of that, what are the things you want to do? Oh, we're taking that Disney trip with the kids and the grandkids, or we're going to go, we're going to start checking these bucket list items off. So that's where we need a financial plan really comes into play. But so I think people underestimate sometimes the needs they have, but they also overestimate many times what exactly they're going to need in retirement too.
Yeah, I think so. So when you were talking about that 4-letter word that starts with a B, the budget, I'm amazed. Well, I'm not really surprised by this. This is a very common response that I get, but I don't think the client's expecting it. So there are some budgeting sheets and tools that we have to help people get an idea of what they spend. And you don't have to hit this on the penny, but it's just to give us a good idea of kind of what does it cost for you to run your household, right? Keep your lights on, keep food on the table, subscriptions, your streaming services, whatever that may be. And a lot of times, 8 times out of 10, after folks go through that exercise, one, they usually say, John, hey, this is a great exercise, but I'd rather go have my teeth cleaned. And I said, I hear you. I was like, I get it.
Or pulled.
Hey, let's just go through the exercise. Let's just get to the data. But most of the time, 7 to 8 out of every 10, I hear, I had no idea how much these little expenses that I thought were insignificant, when you put all this together, how much they add up. I had no idea how much I was spending on coffee, subscriptions. The biggest one, Amazon.
Oh, I bet. It's so easy.
Oh, it's so easy, right? So you look at that, but then, so maybe sometimes the budget, they're a little shocked at how much they're spending on their basic living expenses. But then to your point, Danny, maybe they overestimate. Well, here's what our travel budget's going to be every year moving forward.
Yep.
It's like, well, and I look at that number and I go, well, where are you going? Can I come along? I mean, but then do you really spend that amount every year moving forward? Probably not. We can. There's some give and take, and we can adjust those expenses moving forward.
No,
right?
That's right. I mean, I think that there is a lot of give and take. Visited with somebody else this week and said, taking care of parents, don't think we're not spending nearly that much. Don't feel comfortable leaving them. And that's a very common theme as well. Some of the other things I think is that not saving. And not saving at the right time, right? Yeah. So, this may not be for many of you out there, but if you are younger, a lot of times life gets in the way. And many people we talk to, you evolve, and where you start off, you're trying to save, you're just trying to make ends meet initially. As you get out of college, you may not be saving as much as you should, but then, okay, you finally get in a groove, you save for a little bit, and then you have kids, and it's like, oh man, life gets expensive very quickly. And then finally they get out of the house, and you're in your 40s or 50s, and you begin to save again. And it becomes difficult, right? Because now we're much closer to retirement. And everybody talks about, compounding is, the eighth wonder of the world. And while it is, What most people don't tell you about, though, is that compounding only really works if it always goes up. Now, compounding is great. There's no doubt about it. But we have to be mindful of, and careful of a lot of these. I hear a lot of stuff out there that says, well, if you saved $2,000 a year from the time you're 18 to 30, and you make 8% a year, and you stopped saving at 30, and then somebody who saved from 30 to 65, you would have that same $2,000 every year. So essentially for 35 years versus 12 years, you would have more money than them because at 8%, here's how it compounds and here's how it works. Well, that's great. And there is some truth in the sense that starting early helps. There's no doubt about it. Find a way to save. And this doesn't matter what kind of stage of life that you're in, but do it. Get it done. We talked about setting it up automated. I think that's fantastic. Something you need to do. But there's also something about being thoughtful and diligent about it, where you go in and manually do that. I think also helps, John.
Yeah,
the
I think
problem
so.
is it gets away from you.
It does. It gets away from you. You're talking about how life happens, and all of a sudden, you maybe you get married, you have children, and all of a sudden you go, "Wow, where did that 20 years go?" Right? It's like,
Yeah.
oh man, I better get caught up. But it's so if you can see, I'm a big believer in just automating things, set it and let it start, right? So that way, it's you set this saving discipline when you're young. Start whether if it's you're starting off, you're coming out of school and you're starting your first career, and it's your Roth 401k, and you start putting money in that. Just set it. So just start setting money aside. But then to your point, Danny, as your income grows, get in there and increase the percentage that you're saving every year, right? Get in there and manually do that and see that progress, right? So, but put it in place and set it so that way it just happens automatically, right?
Yeah, see, that's one that I think everybody knows, but not as many people put into practice.
Yeah.
Every time you get that pay raise, don't go out and buy that new car. Don't go out and buy, most people upgrade their lifestyle instead of upgrading their savings account and putting those funds aside. Whereas, as we're being accumulators and we're working hard to try to grow our wealth over time, I think this is extremely crucial. And what an easy, I say easy. I don't think any of it's real easy. It should be.
It should be, but it becomes emotional.
Yeah.
Right.
Yeah.
And it's a little scary.
That's right.
It is a little scary, and there's still a lot of education that needs to be done just around some of the basics when it comes to saving and putting money aside, right?
Yeah, financial literacy is certainly at an all-time low, and there's things, and that's why we do spend time on some of this easier stuff that, and maybe it's just easy to us because we talk about it each and every day, at least from a, talking about it standpoint. But these are things that you can do. These are manageable. These are things that you can put into practice right now, today, to ensure that you're setting yourself up and your family up for the future. And that's going to be key. And so we're going to talk a little bit about some more tips here in the next segment. Do want to get to taxes. What does that mean as far as, when we're looking from a planning perspective? What do people need to be considering? What does that mean for you, your money, and the economy? We'll be right back.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
So you're ready to retire, but are you ready to transition to Medicare? Knowing how health insurance works after you leave your job is vital. Our next Lunch and Learn will tackle transitioning to Medicare, Wednesday, May 15th, with Danny Ratliff and Richard Rosso. How do you sign up for Medicare? And how will it work with the insurance you already have? Food for thought and food for your belly. Register now for our Transitioning to Medicare Lunch and Learn with Ratliff and Rosso at realinvestmentadvice.com. Realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
Part of the problem of the average American is that we've just chosen to live well beyond our means.
Basically, you can buy anything you want out there on a payment. You need new underwear? Go get it on a payment plan.
Underwear can be expensive. If you buy some Jimmy John's, they're not cheap.
Jimmy John's.
And
Sandwich
the point
underwear?
is,
What is this?
But Tommy John's, thank you.
The Real Investment Show podcast
That's why I just don't wear underwear. It's too expensive anymore.
at realinvestmentadvice.com.
Going commando is going to become a new thing for the poor people.
It's going to be a...
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access, like Technically Speaking Tuesday, Financial Fitness Friday, plus each day's radio shows. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
Welcome back to the Real Investment Show. I'm Danny Ratliff here with John Penn. We're talking about things to think about or prepare for leading up to retirement, in retirement, I think at any stage of your life. But John and I were just talking off air, and Brent, in between the break, about payments. Mm-hmm. And I think this becomes problematic. This is a bigger issue than most people realize. Is that we have the ability to put everything on a payment. As Lance said, we can put Jimmy John underwear.
I thought those are sandwiches.
They are sandwiches. I just like giving Lance a hard time.
I want a Tommy John on rye.
Maybe we... I'm not
Does
even,
not sound very
I'm not even going to
appetizing.
go. It is Friday. I'm not going to go there. It's all good.
So, but... to the point is you could put underwear on a payment plan. You can put anything on a payment plan. And it's to the detriment of most Americans. We don't think about the big picture anymore. We don't think about the cost. We don't have the delayed gratification. We don't have the just common sense approach that if you don't have it, don't spend it. We think about give it to us now and we'll figure it out later. The issue is, we talked about this, with we're seeing record levels of credit card debt. We're seeing delinquencies creep up. We're seeing interest rates certainly become a bigger issue with that, and inflation, and people are having and struggling to make ends meet. We know the numbers. We know how many people can't meet a $400 expense. Mm-hmm. And so retailers also know that. And so they say, well, you can't come out here and just flat out buy this product, especially as we've had to increase our cost. So now we've got a better way. We talked about it a couple years ago. Rich and I were when Apple increased the price of an iPhone. I thought, oh my gosh, these guys are idiots. What are they doing? I'll never buy an Apple product again. Can't afford that.
It's called cash flow, baby.
Well, they annuitized their business. It was genius, right? Because they realized something, and that they know, okay, everybody's upgrading their phone. Why don't we go ahead and just put them on a payment plan? And then they'll always have a payment plan for the rest of their life. Kind of like most people with vehicles. Most people always have a car loan.
Well, now look at car loans. I mean, they're, an 84-month, 96-month car loan. You see those being advertised everywhere, right? Yeah. So, great example. Let's say you've got a car loan. You want to have that over, let's say a $35,000 vehicle. Now, this is an example, 9% on the loan. Your monthly payment's $871. Well, Danny, I can get you in that same car.
So, hold on. Go back on that.
Yeah.
$35,000
vehicle.
Which doesn't get you a whole lot these days.
It doesn't get you much these days.
Yeah.
In this example, 9% for 48 months. Now, your payment, $871 a month. Oh, I can't afford $871 a month. Well, that's okay, Danny. I can still get you in this car.
How bad do you want this car?
How bad do you want it? We can get your payment down to $563 if you go out to 84 months. Oh, well, that's almost savings of $300 a month.
Oh, but is it?
Is it? But look at what they don't tell you is, one, they're not, unless you ask, they probably won't point out, by the way, that, hey, the rate on the loan is 9%. Oh, and by the way, if you finance this for 84 months, your total amount of interest that you're going to pay isn't going to be $6,800. It's going to be more like $12,300. But, well, we're not going to talk about that because we just want you to get the car with the lower payment.
That's right.
It's the bigger picture, right?
Well, it is a bigger picture. And I think that's where, and especially in this instance where you do have a rate associated with it, you need to have a very good understanding on what your lifetime expense is going to be on each and everything you purchase. Right? So that's a great example. And I love that you brought that up because those are things that people don't see. And we need to be so deliberate about all of our spending and things that we're doing and understanding where funds are going. And I understand most people don't want to do it. We want to live free and we don't want to worry about stuff. But at the end of the day, this stuff matters. And that matters to the tune of, what'd you say, $12,000?
So, yeah. So if you looked at financing that particular vehicle in the example, $35,000, 9% for 48 months, your total interest was going to be, give or take, $6,800. But if you extend that loan out, same vehicle, $35,000 at 9% for 84 months, your monthly payment goes down to $563, but your interest expense is, it's almost just under double. It's $12,300.
Yeah.
That's huge.
It is. That is tremendous, the amount of money extra that you're spending there. So I want you guys to think of debt anytime that you have it. We're just taking future cash flows. So money that we would have to spend in other areas, now that money is gone. And I know we always think we're going to get a pay raise, we're going to get a big bonus, you're going to get something great is going to happen, and I love that optimism because I think that we're optimistic as well in general.
Absolutely.
But is it practical? What if it doesn't happen? What if life gets in the way and throws you a curveball? These are prime examples, I think. So understanding that, it's not just a payment, but there is a bigger price tag associated with that, especially when there's interest involved. Going back to the Jimmy John's underwear. No interest payments for 4 payments, whatever it is. That's great until you don't make that payment.
Yeah.
And it all adds up. So like the little things that you mentioned earlier, I didn't realize the Amazon, the subscriptions, the little stuff that just adds up. And I deal with that too. I mean, I'll tell you what, I look at our credit card, and I think we do a pretty good job in general. And I'm like, holy smokes, how did we already spend that much money this month?
Yeah. Well, and so going back to something else to think about, especially with the car example. So now, you're keeping that vehicle, assuming that you keep the vehicle for the full term of the loan. That's a longer period of time. Now you're financing a depreciating asset, right? So you've got this negative equity, and now maybe it's time for a new vehicle. So you go back to the dealership, and oh my gosh, you're upside down. So what do? Well, that's all right, Danny. We'll just take that negative equity and roll it into your next payment. It just keeps going and going and going, right?
So what point is that too much to either pay for? Because now that negative equity. So let's say you still owed $10,000 on that vehicle. Now, there are ways and things that you can put in place to prevent that from happening. I don't feel like most people probably do because it is expensive. Gap insurance, things of that nature. Now, but what happens when you have that? And now that $35,000 car is now a $40,000 car plus the additional $10,000 on top of it. Or you need to get out of the car to get in the SUV as your family has grown. And so all this just adds up.
Right. It's just the ripple effect, right? And it goes back to some of the things that we were talking about earlier about what are some things to look at as you're setting yourself up for success in the future, not just setting yourself up for success now, but things you just need to be aware of as you go down the path, as you get near that point in time where you're like, Danny, I don't know if I'm fully ready to retire yet. Maybe I just don't want to be working the hours that I'm working, or, hey, I am ready for the next chapter of my life here. I am ready to make a change. So that way you're setting yourself up to have that, the best probability that you're going to be able to make that change and enter that next chapter of your life that you and your significant other want to enter, right?
That's right.
Yeah.
It's like we just turned into Dave Ramsey here.
Well, we aren't promising growth mutual funds of 12% a year.
Oh, that is true.
Sorry.
Very true.
Singa.
Very true. But, I think this is valid. I think this is all part of the bigger picture that needs to be understood, and also just that one piece of how you kind of weave in and out of retirement and get towards it. There's lots of things that are going to occur. I think that, making sure that you control things that you can control, and we can control our spending to some extent. But it's not easy.
Yeah.
And so I understand that things are not cheap. Inflation's still here. Maybe your paycheck hasn't gone up as much as you'd like. I get it. But we've got to, we need to, this is one area where I'd want you to overthink this. Now, overcomplicating things I think is easy. And, from an investment standpoint, sometimes I feel like, especially maybe if we don't have as much knowledge on it, or we have too much, we invest, and I'm not saying we, but in people in general, will invest in so many different things. And sometimes it may be the hottest thing on the market. Sometimes it may be the newest, idea. Keep in mind, Wall Street is there to sell us products. I like to tell people, I don't work for Wall Street. I work for Main Street. I work for you, for people. Now, is this a tool? Absolutely. Is it a tool for wealth? Yes. We also need to be smart about how we approach it. And many times, John, when you see somebody, you visit with a lot of people and see financial plans, sometimes you see stuff that is just there's so many different moving parts with it that I'm not sure how they ever took an inventory of assets and understood exactly, how things work together.
Right.
What would you tell somebody like that when you have a lot of different types of investments, investment vehicles, you kind of see a smorgasbord?
Yeah, I mean, how does it all come together to drive your situation forward, right? And if you have so many different moving pieces at so many different locations, how are you able to keep your arms around that, to manage that? And then heaven forbid, if something were to happen to you, how knowledgeable is your significant other or your family about everything that you have going on? So heaven forbid, if something happens to you, let's say you predecease them early, what type of situation, or for lack of better words, mess is this a mess that you may be leaving for your future loved ones, right?
Yeah, I wasn't even going there yet, but that's a great point. I was thinking more of just the actual management of that in general. Like, okay, you've got all these things. How do you take distributions? Can you take distributions?
Yeah, great point.
Especially when sometimes we start getting in these sophisticated or alternative types of investments, there may not be the ability to go out and take even your RMDs. So we'll talk more about that, finish this up. I do want to get to taxes. I swear we're going to get there. We'll be right back.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
So you're ready to retire, but are you ready to transition to Medicare? Knowing how health insurance works after you leave your job is vital. Our next Lunch and Learn will tackle transitioning to Medicare, Wednesday, May 15th, with Danny Ratliff and Richard Rosso. How do you sign up for Medicare? And how will it work with the insurance you already have? Food for thought and food for your belly. Register now for our Transitioning to Medicare Lunch and Learn with Ratliff and Rosso at realinvestmentadvice.com. Realinvestmentadvice.com.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
The Real Investment Show.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
Welcome back to the Real Investment Show. I'm Danny Ratliff here with John Penn. So, I know a lot of you want to talk about taxes, and we've been trying to finish up a conversation for the last 2 weeks, John. So, but we're gonna jump around. Executive decision. We're gonna make a change here and pivot into taxes, but I promise we'll get back to the rest later. So lots to be said about all the things that are occurring right now. This week, there's articles and op-eds in the Wall Street Journal. If you just go out and Google Biden tax rates or tax cuts, you won't find tax cuts. You'll see tax hikes.
Tax increases.
And so really kind of an odd thing to campaign on in an election year that we're at. And part of this, I think, is probably to go after Trump because the Tax Cuts and Jobs Act that was enacted in 2018, passed in 2017, will sunset at the end of 2025. So if Biden is reelected, I think we can have a pretty strong assumption that that completely goes away. Now, the issue that we have now and some of the bigger problems, so we know if nothing is done, this may not matter who's in office at the time, that this tax code that we are currently under expires. So what does that mean for most people? That means that, number one, our brackets are condensed. They begin to shrink a bit. The percentages go up a little. And so while, this is quote unquote, we're saying this is for the rich, it's for everybody. If you look at the bottom half of the population, they currently pay about 4%, or they did pay 4% in taxes. They currently pay about 3.4%. Mm-hmm. They will go back up and they will pay a little bit more. Pay your fair share, guys. The wealthy went from about 26% tax rate to about 25%, right? So they saw that come down a little bit. The wealthy are still paying their fair shares. We talked about last Friday on the show and looked at the actual tax brackets and who is paying what. The wealthy is paying about 75% of the overall taxes. The bottom 30-40% are paying very little, if not anything at all, and many are getting returns. So don't buy into that narrative. Now, I think what is more troubling and what more of the headline news is as of this week has been what happens to the capital gain rates. So, looking at short-term capital gains, and And dividends is the other aspect of this too. But if we look at capital gains in general, we have our short term, which are taxed as ordinary income. So anything that we have held for less than 1 year. Then we have our long term capital gain rates, which is anything that we've held 1 year or more. And so a lot of people will make decisions surrounding how long, the length of time they've held something, what the current economy looks like, just to ensure that they get that preferable tax treatment. There's also ways right now where, depending on your income, if you there's income limitations where you may pay 0% in capital gains. So there are some nice caveats to what we currently have at the moment. Now, the headline is that Biden capital gains proposal 44.6%. So once you think about that, you make $1, you're going to pay, now this isn't for everybody, it's only for the rich, 45 cents. Now, the proposal is a little bit, there's all these nuances to these, but it effectively raises long-term capital gains and qualified dividend rates to 37%. In addition to some other, kind of asterisks here and there, that can bump it to 45. Now, do I think this is going to be something that's done right now? No. I love how the narrative has been that everybody needs to, this problem with the deficit, $2 trillion in deficit. Well, no, that's government spending. I'm pretty sure that you and I do a better job of allocating resources and funds than clearly what these guys have done. But I'm not going to get super political because that's all these politicians. I don't think it matters what side of the aisle you're on. Mm-mm. They're spending money like it grows on trees. It is bizarre, but it's not their money. And it's super frustrating. So I do believe we will see higher taxes. I don't know how you don't. If you have a non-revenue producing, can't call it an asset, a non-revenue producing entity, but you and I produce the revenue. So where are they going to go? John, hey, knock, knock. Need you to pay a little more.
Yeah.
So I think there's a lot of frustration around this. And so if this actually did come to fruition, you would see other places like, for instance, think about this, states with capital gains rates. So many states they're going to exceed 50%. California would face a combined federal state rate of 59%. New Jersey 55.3, Oregon 54.5, Minnesota 54.4, New York State 53.4. Now keep in mind these are not indexed for inflation either. So that's another problem that we face. But John, we're talking about people moving. Whew, man, that may change. There's also a little side note, and we've talked about this in the past as they've kind of subtly thrown this out. Unrealized capital gains. So key word here, unrealized capital gains. So not only are they going to tax you along the way before you physically sell something, but then when you sell it, they want to tax it as well. But don't worry, it's only for the rich. And there's been proposals that say we're going to do that for people who have over $100 million worth of assets, or only for billionaires. That's fine. And you say, well, that's not going to impact me. But it is. So number one, this is a redistribution of wealth. And if it starts at the top, it ends at the bottom. So you're going to have, think about this, you may be worth more on paper than what you have at the bank. And so if you go out and they say, well, hey, Brent, John, your home was $100,000. Prices just keep going up. It's worth $150,000 now. You're going to have to pay a 25% tax on that $50,000 increase.
Even though I didn't sell. It's unrealized.
Well,
Correct.
The state of Texas is already doing that on your property taxes.
Yeah, they're getting you there, right? And they're there's lots of things right now that they're trying to do to pass to eliminate that. And there are ways to supposedly, well, not supposedly, but they can't increase it so much each year. Now, with that being said, that's $12,500. Does everybody have $12,500 laying around that we can just say, hey, you know what? We're going to do this on top of our property taxes, on top of everything else that we have going on. And I'm using that as an example because, no, they're not saying they're going to go tax you if you have a $100,000 home and it goes up substantially. But even if it goes up 10%, right? You're at 110. You got $2,500 laying around that you're going to just pay. In addition to everything else, we talk to homeowners every day. I know how much your insurance premiums are going up. I know the struggles you guys face. So, but the problem is that this isn't for you. It's only for the rich. But what do the rich do? They own businesses that you probably work for. They own assets. So now if they have forced liquidation of assets, what happens there? Do prices go up or do they go down? Mm-hmm. But also, if they own a business and they're going to be taxed on a regular basis on the growth or valuation of their business. Number, this is an accounting nightmare. I mean, I can't imagine. I'm assuming CPAs are probably lobbying very hard for something like this because they're going to stay in business. They're going to have more business than they will know what to do with. But think about the logistical nightmare here. But with that being said, what does a business owner do? Well, they're going to reduce headcount or they're going to increase prices. And maybe both. Because now the cost of doing business just increased that much. So we thought we had an inflationary problem. This economically, this is going to be a significant struggle. But so John, if you're thinking ahead, and let's just say that this is a big nothing burger. Nothing happens with it. But the Tax Codes and Jobs Act goes away. What do you do?
Yeah. So you got to kind of bank on, taxes and expenses going higher. So what are some things that you can be doing now to maybe help smooth out your tax burden over time, right?
Yeah, absolutely.
So I know we talk a lot about Roth, right? Does it make sense? Pay a little tax now versus maybe potentially paying higher taxes in the future, right?
Yeah, that's absolutely right. Mm-hmm. I mean, and if they did something even more significant where they actually went out and increased, not just to mention that this Tax Cuts and Jobs Act goes away, but let's say that they have a new tax bill that actually gets passed that is much higher taxes. We may not be talking about Roths anymore. We may be talking about, hey, pre-tax.
Yeah.
Now, I'm not sure that's what they want. Now. Yeah. I think they want our money now, just in general. And we're seeing that. There's been a lot, people concerned about the Roth going away. There's been a lot of tax code and legislation as of recent that have actually incentivized people to put funds into those types of accounts so we can pay taxes now. But you look at the Roth right now. You look at going ahead and taking capital gains. You look at some businesses may go ahead and start saying, you know what? We need to sell now. What's going to happen in the future? We don't know. We don't want to deal with it. We're going to try to get our funds as quickly as we can. But, we could go on and on about this. I mean, this is a subject that I think is, fairly contentious for many.
I think so. I mean, you're talking about people moving. They wouldn't just be moving in the U.S. They'd be moving out.
Yeah, maybe. Mm-hmm. Yeah, you think about that, where capital gains rate are across the globe. China, 20%, not even close from a corporate tax perspective. You look at all these other things that are occurring. But, hey, appreciate you guys joining us today, this Friday. We look forward to seeing you all next week. Everybody have a great weekend. We will see you guys next week.